Welcome back. Good morning, and it's a Saturday morning. Hope you're having a good one. Prakash Diwan joins us on the show. Hi, Prakash. Good morning. How do you feel this morning? Good, I'm guessing.
I know what you want to hear, but it's okay. I mean, it's just that we got to live with that shift in terms of the days that we work. So Monday being off possibly will
Yeah.
probably be a decent enough compensation to the hard work you're doing in today.
Oh, okay, Prakash. So you've all revved up the engine then. So you're set. Let's get cracking. Reliance Industries. How do the numbers look? Sonia told us it was looking pretty good.
Oh yes, of course. I think what people need to understand, and I'm sure people will, is that on a scale like this to continue to grow, and now that the transition is very evident and absolutely well established, there's no ambiguity around that. The customer-facing businesses have actually marched ahead with such promise that I would be surprised if retail starts getting discussed with a valuation which is which is at par with global comparatives in terms of valuation metrics. The scale that they offer, the kind of price points that they straddle, the kind of product range which is covered is just phenomenal. So my sense is this is kind of these numbers actually very clearly tell you there's something which should happen in terms of a value unlocking on the retail side to begin with, and then possibly the digital business.
Okay, absolutely. I mean, the only thing, with Reliance, I was going through some of the brokerage notes. The capex has fallen to an 8-quarter low this time. And this is the slowest investment capex that the company has seen in the last 2 years. So that's just one thing to point out. But of course, consumer-facing businesses are doing extremely well, so no problems about that. Prakash, hi, good morning. Never thought I'd say this to you on a Saturday morning, but we just saw each other less than 12 hours ago talking about Reliance's numbers, and now here we are. We're also going to talk about HUL's numbers, right? Because those were disappointing and there are demand challenges. But as an an investor in HUL, what do you do now?
Good morning, Sonia. So, I do agree. There is definitely something amiss in terms of HUL, and I think that kind of represents the entire FMCG side. Except for a Tata Consumer or a Godrej Consumer, which have different reasons to grow and kind of get attractive. I think the core businesses in the FMCG space are finding volume growth to be very difficult. So whatever they did in terms of price increases and grammage reduction and all of that is kind of played out. There's not much left in that war chest. Most of the FMCG players will actually now have to depend on demand resurrection, and that could probably be still painfully away. At least 2 quarters post the monsoon, if things look different, there could be something else. So I would, if I'm an investor in HUL, I would probably move to an ITC because there are certain triggers that are very imminent out there, Sonia. Particularly the hotels business getting demerged out of that, carved out, will probably be a very positive spin-off. So you'll finally see a very clear FMCG-led business and, of course, hospitality business getting separated, and there'll be value accretion in both. So HUL probably doesn't have much of firepower at this point in time. So I would, but it could surprise us if the demand numbers start looking up because the base has been made. It's absolutely at a bottom.
Okay, what about Paytm? This time the numbers are good, the EBITDA has improved, the losses have gone down, and that stock has sort of come back into investors' radar. At this price, is it still a buy?
So it depends on what kind of timeline you attribute to this kind of a thing in terms of unlocking a value. So there were restrictions by the RBI that kind of brought things to a little bit of a slowdown. But I think their metrics have definitely been improving. So what happened to, let's say, Zomato when they realized that path to profitability is something which the onus is on them and not on the market or not on the consumer segment? That's exactly what Paytm is also doing. And remember, Paytm has a lot of other optionalities, Sonia. I mean, it's not just the payment transaction business. It's not just the loan business. They also have the POS business, which I've seen, as I keep pointing out, as a very promising area where they could kind of have some sort of a sway. So there will be all of these which will start adding to it, and then things start looking very different. So if you are willing to hold on for at least a couple of years because the turnaround could take some time. It's very gradual, very slow, but it's distinctly finitely there. So it depends on that. But even if you don't buy it right now, I'm sure you're not going to miss out on too much of an upside. So let me also add that caveat.
Okay, all right. Prakash, what about the largest weight on the index, HDFC Bank? How do you approach it? At around this 1,470 rupees, or there are lack of positive triggers, mind you. And the next few quarters, we'll still be waiting by for management commentary. But at
Absolutely.
1,470, if you give a value of say 230, 250 rupees at least to its subsidiaries, you're having the core business at around 1,250 rupees, very, very roughly. And they're going to do an EPS after being scaled down at around 97 rupees. You're getting one of the largest banks at just, sub 13 times its earnings. Valuations will support, lack of positive triggers, yes. But do you think downside is limited from here?
So Nigel, that's what happened. The market never obliges with a very linear, fair kind of a growth for any of the stocks. I mean, you have extremes of pessimism and this greed, which kind of between which we prevail, right? So what's happened is the expectations were very high when we went into earnings from HDFC, and people were woken up to the reality that it's just been a quarter for the merged entity to have flexed itself. They'd set the very clear expectation in terms of what, waiting for at least 3-4 quarters before the bad loans would kind of get ingested and digested and then kind of moved on. But one thing, the respite for HDFC, in my view, comes from, apart from, of course, the valuation being so soft and benign, comes from the statement that the RBI governor made in the interview Shireen had with him, in Davos. So where he said there's nothing like a very clear, defined CD ratio that's been, attributed to the sector or been assigned to some or been expected out of a company or a bank. Now, which means that, all this liquidity related, CD ratios related issues that we felt that the deposits aren't growing as much as credit has grown will probably come to rest. And in the meanwhile, the branch expansion that's underway could probably start changing the profile in terms of what they can mop up as deposits as the merged entity. So there's lots that probably time would heal. If you buy at these levels, to be honest, there's absolutely no risk on the downside. How much more it can go, the most of the selling's been done. And if inflows keep coming, which you would expect if things look up for the next couple of months, by March end, HDFC and some of the other banks would look very differently strong. So I'm sure there's more value than what it was at 1550, 1600 than as compared to what today. So look at it from that perspective, but give it time. Don't expect just to correct back to 1700 in a hurry.
But Prakash, what's your view on RBL Bank? We'll be chatting with the management later on in the show. But did you have a look at those numbers and how would you view the stock? One point of time it was $100, $120. That was a good entry point. But now it's closer to 300 rupees. So your view. Prakash, I think we need to unmute you. We would love to hear what you have to say.
Yeah, I said, RBL Bank cases that the valuations are such that it actually makes it more vulnerable to some sort of a correction. People are not going to like the fact that slippages are going from more than just one segment. It's not just credit cards, which was a culprit last time. It's, MF, microfinance, which is kind of letting them down. So, and there's not much of a way they can grow at a pace which in a tight interest rate regime, which will be very significantly different. So there will be some sort of a punishment that it will probably get from these numbers. There's nothing which is very encouraging in any of the metrics, Nigel. So I would be cautious and look at where the larger private sector banks are trading. Right? Even if you don't look at the top four, you go to a step down and look at an IndusInd. There's nothing wrong with that. So you would rather buy something which is much more resilient as compared to something which kind of shakes your confidence every quarter. So I'm a believer. The bigger banks on the private sector are definitely something which you need to look at far more seriously than ever before.
Got it. All right. The other is I'm glad, it was a cue for me to ask you about the bigger banks in the private sector space, because last week, the biggest talking point was HDFC Bank, right? It was the biggest weekly fall in 3 years. The stock was down 10% last week. Hand on heart, don't you think this is a great opportunity to buy HDFC Bank despite all of the, volatility that we're seeing in numbers?
Oh, absolutely, Tanya. So as I said, where else will you get this kind of a valuation? Now, whether you want to buy HDFC Bank or not, that's the question. There's a lot of debate around why HDFC Bank at this valuation was, at the erstwhile valuation was so sought after as compared to some of the global banks like Bank of America and all of that. But people need to understand India is a very different market where this is one bank that has absolutely the right to win in terms of spreading itself, expanding itself. There have been technology letdowns, which related letdowns, which they are plugging, I'm sure. So there's lots that's happening. So all of that takes time. It's a turnaround of sorts after the merger. Two giants coming together. It's not something very easy. The earth underneath is going to shudder a bit, and then that's what's happened. So my sense is you buy into HDFC Bank with a slightly higher expectation. Give it some rope. Don't expect it to turn around in just a couple of weeks or one quarter. So that's the whole idea. But I don't think things can go worse than where it is in terms of valuation, with all the subsidiary valuation also kind of built in, and they are growing so rapidly, be it asset management, insurance, general life, all of it. So I don't see why that would be such a big issue in terms of growth not going ahead.
Okay, all right.